Howdy there, folks. Welcome into the buy one, get one free here today in this video. Two videos to react to, okay? These are pretty much opposite type videos here, okay? First video up here, 2023's market will likely be the inverse of 2022. First off, respect the courage of somebody coming out and saying that, okay? Whether they're right or wrong, I think that's cool, okay? I think that's cool because I can tell you no one's really talking like that. And the fact that this has a possibility of being an inverse year is just interesting, right? And you never know, it could be. I mean, if you see the correlation, actually, this year is setting up so far basically exactly opposite of how last year started out. And last year started out horrible right off the bat. The market started tanking, right? And then the market did start coming back prior to obviously Russia going into Ukraine. And then once Russia actually went into Ukraine, obviously the market tanked from there and it got really, really ugly. Then we tried to have another comeback and then to tank to new lower lows, right? Then another comeback, then tank to new lower lows. And then we started bouncing over the past few months. So we'll hear what he has to say in regards to this, but I just give him respect because that's a out there call that no one's really talking about right now. And I always appreciate that because when no one's talking about something, I think that's the time we should be talking about it, okay? Second video up here, probably the opposite of that video, okay? More likely the U.S. economy goes into a recession in the next few months, says Cannord's Tom Dwyer. So we'll hear what he has to say. I appreciate everybody joining me as always. Thanks for being here, folks. 23,800 plus subscribers now on this channel. Holy smoke, is that ain't no joke. There's 24,000 subscribers coming. I appreciate each and every one of you for being here. It's a lot of subscribers strong now at this point, man. I appreciate y'all. If you're looking to apply to join my private stock group, my private wealth group, that will be in the description area. Let's get into this.
It looks like maybe there's finally some catch-up going on here with higher rates.
Catch-up.
Today has not changed my mind, no. And you couldn't have said it better. We do think that 23 will likely be the inverse of 22. And, this is a period where we might finally get that slowdown. Although that slowdown appears a bit elusive right now, earnings may come in a little bit. And yet the market is likely to go up because we've already had sell-off last year, 25% down, peak to trough.
Yeah, that's true. We'll get into more of this. Obviously, solid start in 2023. May see a mild recession as a byproduct for the Fed action. So that's interesting. So he says we might even see a mild recession, but he's still expecting an inverse of last year, essentially. That's interesting. Slowdown should be light, allowing PE multiples to expand on earnings. Okay.
Anticipating the recession that just continues to look elusive. And I think the argument has nuanced a little bit.
Whoa. Wait a minute. Did you hear what this gentleman just said? He just said this recession feels elusive, okay? Two things. First off, I think we had a recession in 2022. It's just the government didn't call it that for whatever reason. They made up their own reason why they didn't want to call it a recession. For what we had was a true recession in 2022. And I think we would be in a healthier place as a market psychologically right now if we had called the recession an actual recession. Because then we could be like, we're coming out of the recession instead of like still worrying about this recession, right? But, to his point there, if you look at earnings, right, which I look at, dozens and dozens of earnings reports every single earnings season, right? Every single time you're like, oh man, earnings going to have to tank now. And they seem to hold up pretty darn decent. And, I'm actually looking at a lot of these companies that I'm thinking their margins and their net income and their EPS is going to actually increase quite substantially as 2023 goes along. They'll report a better quarter and better quarter. So, that is something that remains to be seen. Is like, this recession, it can definitely come, but it's just like, seems like what's going on here, right? And since we never called the 2022 one a recession, even though it was, that makes it feel extra worse, I guess you can say.
It's gone from, the fundamentals are surprisingly strong. They're mixed at worst, but they're stronger than people anticipated. And as a result of that, we're starting to get this no landing argument. And just like human nature, we just always go to worst case outcomes. So it seems like everybody, or at least today, people are jumping to the conclusion if the fundamentals are stronger, that means that inflation will be higher and hotter, and the Fed's going to have to continue to raise, and that's going to cause a hard landing. I don't know why we have to jump to those conclusions.
I will tell you exactly why, sir. To be fair, and let me take the bear side here for a moment, okay, which never is a fun place I like to be. I like to be on the bullish side. But to defend that, why is everybody going in that worst case scenario? Because damn it, if you look at 2022, inflation went far higher for far longer than anybody anticipated. So when you get slapped in the face again and again and again, you expect to get slapped in the face again, okay? Like, it's human nature, right? If you keep seeing something bad happen over and over again, you start thinking that bad thing's going to continue on, right? And so every single month we thought, oh, inflation has to start dying now, and it didn't die. And then, oh, now it has, and it went higher, and then it went higher, and then it went higher, and it's like, oh, right? And so it's human nature. That's the bottom line in that whole situation, right? So now everybody's looking at it, and they're still scared as heck of inflation and what the Fed's going to do if inflation remains high. So I understand it.
You can have stronger than expected economy, and yet inflation continue to calm as these supply chain bottlenecks that were driven by pandemic and unusual circumstances continue to ease. So why can't you have improving productivity, falling inflation, which is the evidence of the day right now, and a little bit stronger economy? And therefore, to me, that signals recovery and healthy movement from here.
So what he brings up is a true statement. That's definitely a possibility. It's just human psychology and market psychology. When you've been getting worst case scenario over and over again, you just start to automatically assume like it's just going to get worse. It's just going to get worse. You kind of get into that mindset, right?
Case like people jump to.
No, I like it. It's gold. Not a lot of people are talking about Goldilocks right now, but when you look at the way energy prices have fallen and they punch way above their weight in terms of psychological value, headline inflation, all the rest of it, and that's really come down. Let me ask you the question this way. A question from Lee J, one of our viewers, who says, if all of this is the case, why is the market still trading at 18 times? In other words, it's not exactly a bargain right now, given what he says, the macro headwinds and how earnings have come in. He says, I'm baffled. What are your thoughts?
Well, I think that there's no reason to think valuation.
Let me answer this before I hear this, gentlemen, then we'll see if our answers are anything alike. Still can't wrap my head around the market trading at an 18 times forward P, given how earnings have come in, considering macro headwinds. I'm baffled. So basically, it sounds like this Lee J believes that market is too highly valued right now. That's my opinion on this, okay? And I think one of the things the market's looking at is a scenario, and I know this isn't talked about enough, but the fact is, I think the market is looking at a scenario where earnings actually increase throughout this year and get better and better, right? And so Apple has a better 2023 than they did in 2022, which is hard for me to even imagine, but you never know, okay? Amazon, Microsoft's almost a given that they're going to, well, it depends. That Activision Blizzard situation, we'll see what happens there, right? But I would say it's a pretty high probability Microsoft has higher net income and EPS in 2023 than they did in 2022. Amazon net income is going to be night and day better in 2023 than it was in 2022. Google McDougal, they have a lot of issues they're dealing with right now. But even with all that, I believe Google's net income will be better actually in 2023 than 2022, especially with the employee cuts. Meta is going to be night and day difference better. So when you start running through the biggest of the big companies, right, even Tesla's probably going to have net income and EPS go up quite a bit this year, even though they lowered price, right? And even though, we have all these macroeconomic concerns. So you look at all this and you start looking at the biggest companies in the world and you're like, oh my gosh, like it's very high probability that earnings are going to increase. So you can't have a super low PE usually if you're in a scenario where net income and EPS is going to actually probably go up substantially for a lot of the biggest companies that are the biggest weights on the market, right? And so these are things that I think the market's pricing in, but people aren't really like talking about it. They're kind of scared to because of what happened in 2022, and you kind of got made fun of, obviously, if you talked anything bullish, right? Because in the bearish folks looks like geniuses last year. They did, right? It's their, once out of every 5 years that they get to look like a genius. I always say 2 out of 10 years, bears look like a genius. 1 out of every 10 years, no one looks like a genius, and 7 out of 10 years, a bull looks like a genius.
Can stay at a slightly higher or much higher level than is average. So let's say that over the last 5-10 years, it's been somewhere around 16 times is the average. We're slightly elevated. And I think that they contracted from 22 times, which were way higher than where we're at right now, because rates rose last year. Maybe it wasn't because of, fear of earnings slowdown and recession. It was simply that we got PE multiple contraction as rates came up,
right,
and inflation rose. Perhaps they can not only stay at these levels, but elevate a bit from here to that 19, 20 times level if inflation stays under control and the fundamentals are okay. I don't see any reason why PEs would have to collapse if inflation is trending better and price pressure is getting better, the margin pressure is easing. That, to me, would say we could sustain these PE levels or maybe even, see them expand just a little bit. Maybe not back to 22 times. Maybe that was too rich. But somewhere between where we are and that point.
Oh, that's
how I would look at it.
Again,
he went a totally different place than I went, obviously, there. But that's fine.
This is why I love you. Not many people are going to come on right now and argue for multiples expanding in this kind of environment. So let me give you one more from Kang, one of our viewers, who says the market basically ignored the Fed in 2022 and got smacked. Why would they do that again? And we see this today. We just talked about it, this receiver. They're finally going, okay, maybe we are taking rates over 5% by the end of the year. If that all plays out, how do you feel about stocks in the meantime?
Well, our base case is built in with Fed funds somewhere around 5.25, which would be a couple more 25 basis point hikes. And I think we have to put things in perspective again. I'm not a raging bull here. I just think that we could see upside after a 25% peak to trough correction last year. And, people, again, they jump the worst case. I hear comments like, oh, my God, this is unprecedented what the Fed has done. And yeah, we have gone from 0 to 5-ish in Fed funds, but what was unprecedented was 0. We were at 0. We're only going back to normal. So, as Mohammed Al-Arian comes on and talks about the new normal years ago, which was a brilliant kind of spin on things, we're going back to the old normal. We're just going back to normal and people are freaking out. And I just think you need a little more poise and patience to see that it's not as bad as folks think. And in fact, the market trades on trend, not on absolutes. And if you don't believe that, think of 2009 when the market was up 30% while earnings cratered 47% and we were losing 500,000 jobs a month.
Right.
And yet the market was up. And that's all I'm saying. The logic should unfold. The market cares about where we're trending, not where we're at. And I think that we're moving in a better direction.
Yeah, I mean, he brings up a good point there. I think there's just a lot of fear from, decades of rates near zero, right? And the fear is, especially since rates started to go up right before the great financial crisis and the market dumped, right? Then you saw in 2018, obviously rates start to go up, markets started to dump in that situation, right? And then obviously Trump came out and let the Fed have it, and the Fed reversed course. Next thing you know, at the beginning of 2019, and that changed kind of the stock market's trajectory. And so I just think there's a lot of fear about, can you have a sustainable U.S. economy, healthy earnings, a healthy stock market with a Fed funds rate above 1%? Like literally, that's a belief now at this point, right? And we're going to see how that all plays out. But we've had a long history of the stock market doing very well in time periods where Fed funds rate wasn't at 0%. But people sometimes forget that because they've gotten so used to the last decade or two of just these extremely low rates, right? And so it freaks people out. Next video to react to: more likely the U.S. economy goes into recession in the next few months, says Tony Dwyer.
Months and that October low, not really the low. Let's bring in Canaccord Genuity's chief market strategist, Tony Dwyer. Tony, great to see you. So what kind of low are you bracing for?
So why don't we just give it the data? So you open the show with how the 2-year note yield's at the highest of the cycle. We look back since it's been at 500 stock index and since 1957, and the S&P 500 has never made the low of a cycle when it's down more than 19% before the 2-year made its peak. So with the 2
See, Tom Lee's not the only one that brings up random stats and facts, okay? This man can bring it on the bearish side, okay? Two can play that game, okay? Two can play that game.
Making the peak of the cycle so far, that tells you that.
If you watch my Tom Lee video from a few days ago on the channel, right, I was laughing about these random stats that Tom Lee will bring up. And, 16 out of 17 years are positive when the market does this at the beginning of the year. And, it cracks me up, right? And so, you can always kind of cherry pick this data, and I can give you a case on why the stock market should crash, why the stock market should stagnate, or why the stock market should go up substantially.
October low wasn't the low.
Okay, so then But in the notes, you say that the higher the two-year yield goes, the more likely we are headed into a recession. So does that mean you see that in the cards at this point? And so a recession does what to the markets?
I do, Mel. I think the soft landing scenario is because you couldn't disprove the data yet. In other words, you don't go from super fast to a recession in a tick. So it takes time to get there. So what we're basing our recession call on is the percentage of the yield curves that are inverted is at almost 87%. All you need is 55% of them to be inverted to get into a recession. Even the soft landings of 1966, 1995, and 2016, the composite leading economic indicators were nowhere near as weak as they are now. Anytime the LEIs have been here, you've gone into recession. And then lastly, not just the money supply, but the bank lending standards have tightened to a level that, and the loan demand for C&I loans are at a level that have been associated with recession. So to me, the data is there for a recession. We just haven't had enough time to get there yet.
Hey, Tony, so this is obviously backward looking if you have the data here, but do you have any sense of like when stock market in a bear market usually bottom in and around a recession? Because again, this recession call by a lot of strategists and some investors too has been pushed out a little bit. A lot of people were saying just a couple weeks ago, we're in a new bull market and the bear's over. So I'm just curious, if you're right about the recession, maybe in the back half of 2023, how do the stock markets usually bottom before recessions or in them?
Dan, it's a great question. They've never bottomed before recession.
They never bottomed before the recession. See, this is the issue. This is the issue with the market, okay? And this is going to continue to be an issue here for at least a short term, okay? Is because we never called the 2022 recession a recession, that now everybody just keeps pushing out their recession forecasts. They said we were going to be in a recession by the end of 2022. Then they said we'd be in a recession at the beginning of 2023. Now they're pushing out toward the end of 2023. Do you know what's going to happen next? They're going to be talking about at the beginning in the first half of 2024. If we don't start seeing recession and unemployment tick up in any significant way here over the next few months, they're just going to push it out further and further. And it's like, the first half of 2024 we'll see recession. They just keep pushing it. Sooner or later we're going to see it, right? And eventually, you'll be right in that scenario. But I don't think that would be an issue if we had just dang called a recession back last year. But anyways, now we got to deal with what we got to deal with.
The median number of weeks from the beginning of the recession to the S&P 500 low is 23 and a half weeks. So that's why this whole call has been about the recession and why it's so important to use that data I mentioned earlier. So we know that when the 2 years making a peak, the S&P is never bottom before recession.
You see that chart right there? You see that chart?
So the median number of weeks from the beginning of the recession to the S&P 500 low is 23.
Look at that, 20-year S&P 500, 371%. Think about all the drama that's happened, all the bad stuff, all the scares, all the significant craziness, right? And yet, after all of that, 371%, the market's gone up. And think about how many stocks have done absolutely tremendous in that 20-year span, despite the worst financial situation we've had since the Great Depression, despite a once-in-a-100-year pandemic, in everything else that transpired over the past 20 years. Complete drama show. And yet, what do we have to show for it? 371% up on the S&P 500 and countless stocks that went up hundreds of percent, thousands of percent, some even tens of thousands of percent during that time period, right? And so I think it's important for all long-term investors to keep some of these charts in mind sometime, because just remember, whatever we're going through right now is just another thing. It's just another speed bump. It's all it is. It's another speed bump. The market could go to 10%, 20%, 50%. Speed bump. It's all a speed bump, man. It's all just a speed bump. Everybody freaks out, pulling their hair out. Oh my gosh. It's all just a speed bump.
That's why this whole call has been about the recession and why it's so important to use that data I mentioned earlier. So we know that when the 2 years making a peak, the S&P...
It's crazy, man. The great financial crisis was a speed bump. How crazy is that to think, man? A once-in-a-100-year pandemic was a speed bump. Crazy.
He has never made the low until after the 2 year peaks, number one. That means the October low, isn't it? And we also know that the market has never bottomed before the recession even began. So, but what I want to do, Mel, if I can, is be super clear here. We're over a year into this bear market. I want to attack the next low. You don't get Armageddon negative now. We go back to that October low, and I want to attack it because it'll be when finally bad news will become bad news. And that's typically when you make that recession-based low.
And what takes us out then, Tony? Because I think, well, I mean,
is newer to the market that doesn't quite get what he just said. Basically, he's calling the next low the low, and when he says he wants to attack it, that means he wants to buy. The simplest way of putting it, he wants to buy like crazy. He believes we're going to hit some sort of new low, likely within the next few months, and that's when you buy like crazy.
Your work a great deal. What takes us out from that? Like, what are you going to attack on the aggressive side, on the long side?
It's going to be the early cycle names, the financials, the cyclical names, the economically sensitive names. Guy, it's really interesting. The soft landing scenario, to me, is one of it's not the best case scenario because we don't have to guess. We know exactly what's going to happen if you're in a soft landing. Inflation is going to remain elevated. The Fed is going to have to continue to tighten, and the market's and risk is going to get hit. We don't have to guess. That's what happened over the last 2 weeks. So I think what we really need is, unfortunately, to go into a recession to the point where the Fed will lower rates enough that it kickstarts a credit cycle. To Karen's point, not now when we're about to enter a potential negative credit cycle.
So, Tony, how does the Fed pivoting, if at all, factor into this sort of recessionary overlay? I mean, a lot of strategists, or I don't want to say a lot, but some are banking on, some market participants certainly banking on some sort of a pivot, some sort of cutting, later on this year or maybe early next year. Does that play into this at all? And does that change your outlook for when the market bottoms?
It doesn't, Mel, only because when I look back, the only time that I can find after a tightening cycle where the Fed pivoted and it was the low was in 1995. The last rate hike happened, I believe, in February of 95. The market was already ripping, and it just kept going straight up for the year. I think it was a 34% year. So when you look at that, it really comes down to you've got to go have the unemployment rate pick up. And you're in a recession historically when the unemployment rate is 0.5% for an average of 3 months above the low. So if we get a 3.9% unemployment rate, we know we're in a recession. If we know we're in a recession, we know we should be able to be about to make the low. And that creates the opportunity for a real sustainable bull market and a change in that money. The problem is money. It's not just the thought of money. There's the money system is shut down.
Tony, great to see you. Thanks.
Great to see you, Mel. Thanks, guys.
Tony Dwyer, Canaccord Genuity.
I was just smirking a little bit there, and we'll hear what these folks have to say about what he said there. The reason I was smirking a little bit is it's just funny because at the end of the day, every situation is different. A gentleman like that, he's trying to say, well, this happened here, this happened this time, and every single time is different, okay? The great financial crisis was completely different than past recessions, past situations, okay? What we dealt with in the recession of 2020, completely different. Every single one is completely different, and even when he starts talking about, oh, I'm going to play these stocks coming out, these stocks, doesn't work like that, okay? And this is a problem I'm seeing with Wall Street right now, is these folks are in the belief that they're going to be able to perfectly get this opportunity where the market's going to hit a new low, and that's going to be the time to buy, and they're going to get all these stocks at great prices. And I think the reason they're even more hopeful for this is because a lot of them didn't take advantage when some of these stocks were hitting stupid prices back in the summertime and the fall time. They weren't really taking advantage when Meta fell under $100, or when Tesla fell to $101, right? Or when Shopify hit $20-something at late 2022, right? Or when Netflix hit $165 back in the summertime of 2022. I can tell you, a lot of folks they missed it. They completely missed it. So now they're in this hope and prayer situation where they're thinking, okay, I need the market to hit some sort of new low. I need Netflix back at $100-something. I need Meta at $100-something, or below $100. I need Tesla back to $100. And this time I won't miss my opportunity. This time I'll make sure I buy, okay? Shopify goes back to $20-some. I'm going to make sure I buy this time. And I'll make sure I don't miss that opportunity because they missed it in 2022. So now they're hoping. They're like, please happen, please happen. And, it might. They might get their wish. but they also might not. And they're going to be on the sideline as the market goes up more and more over time, and earnings come in stronger, and the news gets better. And oh my gosh, the news cycle's all of a sudden getting better. And well, some of this bad stuff that we kept getting bad thing after bad thing, and now we're actually getting good thing after good thing. And next thing you know, they're waiting on the sideline, and they're like, and it starts to become less and less of a reality to get back to those new lows, right? And so now they're in a very desperate situation. That's what I would call it. I'd put them almost in the same camp of the short sellers. They're all desperate right now, extremely desperate. Us longs are sitting around looking pretty. We're like, you want to send the market down? We'll pick up those shares. You want to sell stocks at stupid prices? Give them. We'll gladly take them. We're not bothered by this, right? We're not phased. But I can tell you these other folks, they're on hopes and prayers now at this point in time. Hopes and prayers, a short seller crowd and the crowd that just didn't take advantage of the silly pricing that happened in 2022. Now they're hoping we somehow get back down to those lows again. It's good luck.
Some more bullish people might have argued that the markets had looked through this, that the October low was them pricing in the recession that was yet to come because it's a forward-looking mechanism. Did you ever buy that, Courtney?
I think there's parts of the market that are going to continue to do well, right? I think it's hard to look at the market as a whole. And I do think it's hard because we're talking the soft landing or the hard landing. And the big crux there is what's going to happen with unemployment. And I still do find it tough to see where we're going to get to that higher unemployment right now, because you're seeing, like, even fascinating today, we saw Home Depot came out and nobody liked their earnings, but they're hiring more people and increasing their wages. So that you have a lot of that happening in industries. So yes, you have your big tech firms who are laying off, but there's still plenty of parts of the country who can't hire enough people. And so I don't know what the catalyst is to get there, to bring unemployment up enough to bring us to the recession, to bring us to a harder landing. And yes, it's a possibility, but I'm not convinced it's happening yet.
Yeah. Karen?
I agree. To me, the employment thing is used to be, 3.4 was absolutely well below what.
Yeah. I think it comes back to greed. The more I think about it, right? The more I think about it, it comes back to greed. The short sellers, they want these stocks to go down. Why do they want them to go down? Because they're greedy. They just want to make money in the short term and gamble in the next one. By the way, if shorting is your main strategy, you are a gambler. You know what I mean? If you want to hedge here and there to hedge your portfolio, fair play. But if you're just outright shorting positions, that's your strategy, you are a degenerate gambler, straight up, okay? So you got the degenerate gambler crowd who likes to do that, okay? And that's just a sign of greed, obviously. And then you got the folks that just want to try to get these stocks, for super low prices, as low as they possibly can, right? And they just can't accept the fact that stocks could go up and we could prosper. They can't accept that fact, okay? That's why they really want it as low as possible. It really comes back to greed, okay? And so, when greed starts making the decisions for you, you usually start making worse decisions, right? And these folks can't just take a step back sometimes and just view it a little longer term. And you'd understand when you get silly opportunities, you better be ready to pounce. And if you don't pounce, and you're not buying Netflix at $100-something, and you're not buying Meta at $80-something, and $90-something, and $100-something, and $120, and $150, and $180, you're just playing a greedy game. Bottom line, you're just not taking advantage of great assets at great prices. And you can play that game. Just understand you're a very greedy person for doing that, and you're in the wrong, 100%. And you will be you will have far less money to do anything, whether it's buy a new home, a new car, go on vacation, give money to charity, whatever it is you want to do. You can play the greedy game, but you will always finish in the back. I wish people knew that. They just doesn't quite hit folks, unfortunately.
Maximum employment used to be, right? Four handle, middle fours maybe. So I would think that this economy can withstand some meaningful move in employment that actually would help the Fed story.
No, it hurts the Fed story. It makes it so much harder for them to, it basically means that Fed funds is going to have a 5 handle for much longer than I think the stock market can endure at the valuations it is at. And just the other thing,
why? Why
if unemployment remains depressed?
Oh, is that what you're saying?
Yes.
Okay, I was saying,
I just think it makes the Fed's job really hard. I know you feel the same way. I mean, I just think it's just, it's one of those things that, and let's just be frank, okay? We talked about Chipotle a couple weeks ago. They're hiring 15,000 workers in North America. These are workers they can fire so quickly, and they will fire so quickly if there is a recession. So, I mean, to me, I just think that with unemployment, if we still get hot readings and we have unemployment below 3.5% or so, it makes the Fed's job that much harder.
I agree. I was saying if unemployment rises.
But she's saying that it's going to stay low forever, right? Isn't that what you're saying? Like, you think that we can actually have a soft.
I'm
it's one of those things that, and let's just be frank, okay? We talked about Chipotle a couple weeks ago. They're hiring 15,000 workers in North America. These are workers they can fire. And they will fire so quickly if there is a recession. So, I mean, to me, I just think that with unemployment, if we still get hot readings and we have unemployment below 3.5% or so, it makes the Fed's job that much harder.
I agree. I was saying if unemployment rises.
But she's saying that it's going to stay low forever, right? Isn't that what you're saying? Like, you think that we can actually have a soft or no landing because unemployment's not going to go up.
I can see employment staying lower for longer, correct? But you're right, it does make the Fed's job harder, which is why we probably are going to have higher interest rates for longer. And that's exactly where you need to look at the markets. All these longer duration assets are going to continue to be under pressure. So, yes, I think we're saying the same thing.
I mean, for June, 5.3% is where Fed funds sit right now. 3 weeks ago, it was 4.9 or something. I mean, like the change in psychology, which is probably what the markets need, it's amazingly fast.
And it's exactly right. It's exactly what they need. It's sort of like the come to Jesus moment where they realize, wait a second, we're not going to get out of this situation as fast as we want to. I'm with you. I don't think unemployment's going to move. The Federal Reserve, I think they want a 5 handle. They would never say that. That's what they need. They're not going to get it. And that's the problem. I mean, because wage growth continues. Inflation is a problem. You're going to see it in the numbers later this week. And they're trying to combat something that everybody seems to think is an easy fix. It's not that easy, which is why rates are going to stay higher for longer. And people are just starting to come to that realization now.
Interesting thoughts there across the board. Man, that was a longer reaction video there. Holy smokes, that was no joke. I appreciate everybody joining me as always. Oh, man, sometimes I watch these reactions and they just get me frustrated. Probably. Anyways, in the market, the best place to be. Don't make emotional decisions. Don't feel like you got to panic out of the market and you got to run and you got to do this and do that, man. At the end of the day, you see great opportunities in the market. You see great assets trading at very undervalued prices. You've got to take advantage of those. Continue to take advantage of those. Don't be on the hopes and prayers game of like, I hope the market goes down. I need it to go down, and when it hits this low, that's when I'm going to buy. Because everybody's trying to play that game, man. Everybody wants to play that game. Everybody wants to have the ideal situation where they're all cash and somehow right at the bottom, the market hits this low and everybody loads up on stocks. It's a fairy tale and it's a fantasy, and it doesn't come true, okay? You see opportunities in the market, take advantage. Otherwise, you're just going to end up a bitter person who's like, frustrated all the time saying the market's too high at these multiples and we need to go down. And even when you start getting good news, you're still pointing out the bad news. That was the old bad news, and you're not looking to the future. You don't want to be in that camp. So anyways, appreciate everybody as always. Much love and have a great day.